Hi, everyone. Thanks for having us here. So in this talk, we'll be discussing what a firm is, how Ergodicity Economics can help us understand firms, and if we can think of a salary as just a negative insurance premium. So I'm Pavel Chvykov, and this works in collaboration with Jerome, who's an economist at the Royal Academy of Sciences of Belgium. And I'll start by presenting the mathematical model so you have something concrete to hold on to, and then Jerome will give some more economics context and real-world grounding to what we're talking about. So what is the firm puzzle? Kind of in parallel to the insurance puzzle in Ergodicity Economics. In a free market where everyone is free to sell their labor in freelance capacity, why do people voluntarily choose to give up this freedom to join a typically dictatorial structure in which a firm is? So why do firms spontaneously arise? Ergodicity Economics tells us that cooperation is good, but we know that it can fail if players default, so sort of take the money and run. So it's a prisoner's dilemma type setup. How can firms perhaps answer this question? And finally, my background is in origins of life, so this question seems very similar to origin of multicellularity, and it would be exciting if the same mathematical ideas can explain both. So, to have a concrete setup, consider n different stock traders. So their wealth could grow as multiplicative Brownian motion processes, which is exponential with some fluctuations. So this is plotted on a log scale here. So if they work independently, then each one has a long-term time average growth rate given by this expression that we know. But if they pool and share their resources at every time step, then they can reduce the second term, which is called volatility drag, by effectively averaging out the noise. The gap between these two extreme kind of scenarios, we can then think of as using to fund cooperation protocol enforcement or administrative fees or things like that. So effectively, we can use the gap between these two to create a firm, right? And there's different ways we could structure that, but one way to think about it is we can internalize the pool and share protocol and then simply pay out fixed wages to our workers so that they're not exposed to any of the risk. And then any salary in the range between these two curves will be a win-win situation for both the firm and the worker. So this is a very kind of simple setup, and it's very much in parallel to how we think about insurance in Ergodicity Economics, the difference being that insurance takes a fixed asset like a car or a house that can also lose value, and we can look at the numbers, but the gist of it is that you can pay the insurance company a fixed price to offload your negative risk. With a firm, we instead think of a skill or a tool, such as you're driving an Uber or you have a chainsaw and you can cut down trees for your neighbor. And we want to maximize the growth rate, right? So the numbers work out very similar, but now you can think of it as the company can pay you a certain fixed amount to take on your positive risk, the risk that you will make more money than a certain baseline. So one immediate consequence of this simple modeling approach is that here, a stable job is exactly the same as freelance plus buying insurance against dry spells. That's kind of nice. Another thing to note is that salaries here are exponential, which might seem strange at first, but actually makes sense. So it's kind of like insurance premium, which is proportional to the value of the asset you're protecting. And also, if you're an investor, then the amount you get paid is going to be proportional to how much you invest. So that also makes sense. But even for laborers, you can think of it, if I'm a company and I want to hire people to work a farm, then the number of people I'll need to hire will be proportional to the size of the farm I need them to work. And so the amount I will pay in salaries will be proportional to the amount of wealth I have. So this exponential paradigm still works in this abstract mathematical modeling context. On the other hand, some issues. So if we look at this multiplicative Brownian motion process, mu and sigma, risk and return, are the set parameters of the model, but W, the dynamic variable, is a little less clear. So in a context of insurance, it would be the value of the asset you're protecting. But if you're looking at a skill, it can be applied to kind of projects of different value. You can work a falafel stand or you can manage a falafel restaurant chain, right? And in particular, a firm can hire you to work their resource, which may be larger than your own. So that's one thing. Another thing is issue of motivation. If you're paying a fixed salary, how do you ensure that workers are doing their best? And finally, in all of this, we assume that you reinvest 100%, so nobody is eating anything or paying rent. And this can also be studied within the same mathematical model framework. So that's kind of nice that these issues can be directly addressed. Okay, so let's go there and generalize this model a little bit to make it more interesting. In particular, now we consider having different sets of skills with different risk-return properties, so with different mu sigma pairs, right? So different trading techniques or maybe different farming methods, right? And out of these, we want to build a firm with optimal long-term growth rates. So in finance, this is just portfolio theory. It's how do you combine many stocks with different parameters to optimize portfolio growth? And if you want to optimize the time average growth rate we study in Ergodicity Economics, that would be called Kelly portfolio. So here on the scatter plot, I'm showing risk-return pairs for 2,000 different NASDAQ stocks, the mu sigmas. And we see that there is an efficient frontier cutoff that naturally emerges where you cannot have any stock that has a lower risk for a given amount of return, right? So that trade-off kind of makes sense. And it also makes sense for skills or for workers. So we're going to use the same scatter plot as kind of a proxy for our firm construction in the following slides. Okay, so the cooperation protocol in terms of portfolio is seen as rebalancing portfolio each day to a certain set of weights, which gives you long-term growth rate by this expression, and you can numerically optimize the specific fractions you allocate to different stocks to maximize growth rate. And so these red dots, basically the color shows how much you allocate. Now for us, instead of portfolio allocation to stocks, we think of this as what fraction of my firm do I assign to a different worker, right? With 0 meaning that that worker is not hired. And so we can optimize that, how much I assign to each worker. And overall, this kind of creates this mean field theory of the firm, perhaps, right? Where we're not looking at the specific network of interconnections among workers. And that gives us a clean, simple model that shows how parameters can affect the firm behavior. So let's look into that. So one thing we can study is that diversity helps in riskier environments. So if we scale up volatility by factors of 1, 2, and 3, as you can see on the x-axis here, then we see that the optimal allocation changes. So in more volatile environments, we want to allocate to more different people, which means we want to have a more democratic firm. So the trade-off between democracy and dictatorship seems to be environment dependent, which is kind of cool. One thing to note in all of these is that this only allocates to high-risk, high-reward skills or workers, right, in this corner of the range, which is clearly unrealistic from perspective of the firm. And I think that's an artifact of overly simplistic noise model in the setup, where independent Gaussian noise is very easy to kind of average out to 0 if you have enough independent noise sources. But in real world, similar to sort of bounded rationality in economics, we can think of bounded creativity, which highlights that kind of the core bottleneck resource here isn't number of workers or even their skills, but it's really diversity of approaches for a given skill that we can then average together to reduce volatility, right? So think of it as entropy is hard to come by because people with the same skill were educated by the same university, and so they have the same kind of pitfalls and risks that they take, right? So independent, uncorrelated noise is very hard to find, right? So if we introduce correlations in this model, then first of all, we note that the growth rate drops drastically and very quickly, kind of by a factor of 2 here, even if we introduce just a little bit of correlations. And second, we know that the optimal allocation is now not only to high risk, high return, but is really concentrated along the efficient frontier, even for low risk, low return workers. So that's kind of, I think that makes sense from a real world perspective, and it's nice that correlations have this impact. So another experiment we can do is to look at the trade-off between long-term growth and short-term survival, right? So we see some of these black curves kind of drop down early on, and if you have an infinite credit line, then that doesn't matter. But if you're in the real world, you might want to avoid losing money. So to do that, you could maximize Sharpe ratio, which is effectively a signal to noise ratio, returns to risks. And that gives you a very different kind of allocation scheme, in particular one favoring low risk, low return workers, right? So that trade-off kind of seems kind of cool and also reasonable. And among all these kind of criteria, we see that a firm needs to manage all these alternatives and optimization problems. And in doing so, it effectively exercises an agency of sorts. And so now Jerome will get into how that's actually important in the context of economics.
Hello, everyone. I would like to very quickly elaborate on what Pavel has presented and to conclude. So in 1988, Greg Dow wrote an article in the Academy of Management Review contrasting so-called configurational theories of the firm, represented on the right by the intersecting lines, the convex one being the so-called production possibility frontier of a firm, what the firm can and is able to produce, with the indifference curve of the individual, what the individual is just able or willing to consume. And where those meet, that's where the purchase and the sale occur. And as you see, very mechanical approach. This is contrasted with so-called co-activational theories of the firm, which emerge very much from ecosystem science and look at very much the dynamic processes and emergent properties that organizations as well entail. So the expected utility and production function framework represented here on the right really has no theory of the firm, in that firms are seen as passive price takers in a very mechanical way, and that assumes an equilibrium. And thus, there is no real place for firm agency because of this view. And our thesis is that ergodicity economics, in fact, brings us much closer to ecosystems science and ecosystem views of firms, because particularly non-ergodic growth processes that emphasize resilience in the face of volatility underline the value of complexity. And value can, in fact, be interpreted economically, as Pavel has tried to demonstrate in some of the discussions that he's had. So therefore, if firms do have agency, they can do many things, in fact, managing resources and relationships. They can disrupt, as Josef Schumpeter has emphasized in his theory of economic development. They can share, they can collaborate, and so on and so on. And so we find the metaphor of an organism or an ecosystem to be much more valid or relevant than that of a machine or mechanism, particularly with reference to the process of emergence. Ergodicity economics can, in fact, as we argue, begin to detail the nature of firm agency by emphasizing what lies behind cooperation, such as the motivations to continue to collaborate. And in fact, it implies that the nature of relations and the structures in which they are embedded are important for the realization of value, and in fact can give us a bird's eye view of differential outcomes. Just to reproduce the graphic on the right here that Pavel described, when the correlation between elements of a portfolio, here interpreted as workers in a firm, increases, in fact, there is a benefit to in increasing diversity of, in this case, workers. So that's one example of the bird's eye view. So if firms do, in general, act to manage complexity, that is one sense of a function of the firm. That's one way to interpret the firm. But what we can ask is what distinguishes firms beyond this basic function? And we argue that the answer lies in the scope and intensity of cooperation. To briefly conclude, we argue that ergodicity economics does move us towards a co-activational theory of the firm, in that organizations, including insurance companies and also firms, represented on the top and the bottom here in the graphic, do reduce uncertainty and do share risk over time. However, there are distinctions between insurance companies and firms. Insurance companies preserve certain values, assets, for instance, whereas firms create and also distribute value. And in fact, the results that we have are that bounded creativity, where there is, in fact, a rise in like-minded people, justifies diversity, equity, and inclusion policies economically, and in fact, it pays to be more diverse. And this is especially the case in volatile environments with correlated individual beliefs, and therefore it is important to look at the going concern, the firm as a going concern that balances short-term and long-term goals. So remaining questions could be how to apply this, or whether this applies as well to interfirm networks, and the role of ethics, psychology, organizational studies, anthropology, and law, among others, in elaborating and supplementing these theories. Thank you very much for listening.